Welcome back again to my YouTube channel, Study with Claire. My name still remains Caleb, and today we'll be looking at another important standard, which is IAS 19, Employees Benefits, which is a very important standard for those preparing for the ICAN examination. So this standard is very important, most especially at the professional level of the ICAN examination. So IAS 19 governs all forms of employees benefits. So as defined by IAS 19, our employees benefits are those considerations. They are all forms of considerations given to employees by the entities in exchange of their services rendered or for the termination of their employment. So once again, I say that the definition of employees benefit as defined by IAS 19, they are forms of considerations given by the entities to employees for or in exchange for their services rendered or for the termination of their contract or for termination of their employment. So that's that. So we say, talked about the definition. There are considerations. So once again, IAS 19 employees benefits, they are all forms of consideration given to an employee by an entity in exchange for their services rendered or for the termination of their employment. So IAS 19 covers all forms of benefits. We know these types of benefits like the pension, the gratuity, the profit sharing, and many of such, final entitlement, and so many more like that. So IAS 19 covers all forms of these benefits except for the share-based payment, which is under the governance of IFRS 2. So all forms of or all types of employees benefits are under IAS 19 except for share-based payments, which we'll also look into subsequently after this class. So that's that. So examples of employees benefits now. We have the pension, gratuity, leave, leave, leave allowances, final entitlement, etc. So these are the examples of employees benefits, which I believe most of us are very familiar with. So we have the types of employees benefits now. So the types, we have one, we have the short term benefits, we have the long term benefits, We have the termination benefits. And we have the post-employment benefits. So for the short-term benefits now, just like the name, the short-term benefits, these are benefits granted for a shorter time frame. So example of this are wages, salaries, and the likes of such. So short-term benefits are just those benefits granted to employees within a short time frame, just is within a scope of just few period. So that's short-term benefits. We said examples are wages, salaries, which other one? Social security contribution, and many more like that. So that's for that. So another one is the long-term benefits. So these long-term benefits, just like we have short-term benefits to be the benefit given within shorter time frame, then the long-term benefits is just the opposite. These are benefits granted to employees for a long period of time. Example of this is the sabbatical leave. So another one is the termination benefits. So termination benefits are benefits enjoyed after the termination of employment. These are just straightforward terms. So termination benefits are benefits enjoyed by employees after the completion of their contract with their employers or with the entity. So example of this termination benefit is like the final entitlement. So final entitlement granted to employees is an example of a termination benefit. Then we have another one, which is the post-employment benefit. So post-employment benefits are benefits enjoyed after the completion of your services with a particular company. So after you've done or you've completed your services with a particular company, then you are entitled to post-employment benefits. So post-employment benefits will not be enjoyed until you actually finish working or you are done working for a particular company. So that's post-employment benefits. So example of post-employment benefits are the pension, which is the most common one, pension and gratuity. So that's for the types of employees benefits. Now the post-employment benefits can be done in several ways. We can pay this post-employment benefits to employees in two ways. We have several ways by which companies can decide to remit these pensions and gratuities to companies or to employees rather. So we have two different ways of the post-employment benefits. So we have two ways of servicing this post-employment benefit to employees. So one of them is the defined contribution plan. And secondly, the defined benefit plan, which is very straightforward. So defined contribution plan, they are post-employment benefits under which entities pays a fixed amount to a separate entity, which is a fund, for the remittance of these employees' benefits or this pension, for example, these pensions and gratuity. So under defined contribution plan, entities make a fixed contribution into a particular fund, that's into a particular entity creating an entity to service this post-employment benefit. So it means that companies will pay another entity to pay on their behalf, so that they can pay their employees on their behalf. Most companies are familiar with this, which is the use of these pension fund administrators. So they pay these pension fund administrators so that they can pay their employees on their behalf. So the risk of the settlement of this post-employment benefit does not lie on the entity. It lies on the risk of not being paid by the employee lies on each of these pension fund administrators. So under defined contribution plan, again, I said the entity makes a fixed contribution into a particular account or a particular fund account to service this post-employment benefits on their behalf to their employees. So that's for defined contribution plan. Then for defined benefit plan, the company, or which is the entity, creates a particular fund itself to service these post-employment benefits, which includes pensions and gratuity, themselves. So in under defined benefit plan, the company or the entity makes an account, creates an account separately to service the post-employment benefits themselves. Whereas under defined contribution plan, the entity pays a fixed contribution to another entity or another fund separately to service the post-employment benefit. So here, the entity pays to a separate entity. But under the defined benefit plan, the entity creates this separate fund. This is fund. So under defined contribution plan, once again, the entity pays a fixed amount of contribution to a separate entity, which is more like a fund, to service their post-employment benefits on their behalf. So like I said, the risk or the obligation does not lie on the entity under this plan. So the employees' benefits, which are supposed to be paid to the employees, the risk of not being paid to them does not lie on the entity under the defined contribution plan. Whereas under the defined benefit plan, the entity creates a separate fund themselves to service these employees' benefits by themselves. So like I said, the defined contribution plan is just what most companies are very familiar with. You pay the pension fund administrators. We have so many pension fund administrators now. So you pay each of them, or you pay a particular one which you have already known. That's a separate entity. So in this case, the pension fund administrators becomes the separate entity, which will service the employees' benefits to employees on the company's behalf. Then for defined benefit plan, the company does not pay any separate entity. They create a separate fund themselves. So they create a separate fund. So the entity creates a separate fund to service the employees' benefits themselves, of which the risk and everything lies, the obligation lies on the entity under the defined benefit plan. So like we have said, under the defined contribution plan, although we'll take an example under this, but this is very straightforward. The company just pays a separate fund to undo the post-employment benefit. While under the defined benefit plan, the company handles the post-employment benefits themselves by creating a separate fund to service these employees' benefits. So under defined contribution plan, they just have a particular amount which they will be paying to these PFAs every year or at every particular point in time, which they have agreed. Then for defined benefit plan, which has more of or which contains more details, is where the company actually finance and services this employees benefits by themselves. So the calculation of the defined benefit plan now, which can lead to assets and liabilities. So for the assets, we have the fair value of the plan assets at the beginning. We have the interest earned, have the contribution paid, we have the benefit paid. The benefit paid will be deducted. So this will give us our estimate. So that will be the estimated value at the end. So we'll compare this with the fair value of the plan asset. So note, if the estimated value of the asset is greater than the fair value of the assets at the end of the period. So what we have estimated is like 10,000, and then what we eventually had was like 5,000. Then it means that there is an actuarial loss. So, so we can either have actuarial gain or loss. So note that if the estimated value of an asset if the estimated value of an asset is greater than the fair value of the asset at the end of the period, then there is an actuarial loss. But if the estimated value as at the end is lower than the fair value of the plan asset at the end, then there is an actuarial gain. So we can have either actuarial loss or actuarial gain. So that's for the assets. And we also have for the liability. So we have the present value of the obligation. We've defined both assets and liabilities before. So at the beginning also, so we also had the interest paid, we had the service cost, then we'll still deduct the benefit paid. So this will also give us our estimate, which is the estimated Then we'll compare that with the present value of our obligation at the end. So just like an asset, but it's the other way around now. If the estimated value of the obligation is higher than the present value of the obligation now, then we have actuarial gain in this case. Have actuarial gain. But if the present value or the estimated value of the obligation, which is the liability, if the estimated value of the liability is lower than the present value of the liability, then we'll have an actuarial loss. So we'll have either actuarial gains or loss. So this is one of the steps in calculating the defined benefit plan. So actuarial gains are just gains arrived or derived from assumptions, like by expecting that we generate this amount of profit or this amount of values. So at the end of the period, it's either we have more than that or we have lower than that. So it's just an estimate. So if we have more than what we have planned for as an asset, then we will have actuarial gain. But if we have lesser than what we have planned for, meaning that if the fair value of the planned asset is lower than the estimated value of the planned asset, then we will have an actuarial loss. I hope that is clear. The other one also for liability, if the estimate we have planned that we'll spend some amount, if what we eventually spend, which is the present value of the obligation, is lower than what we have planned to have spent, then we'll have actuarial gain in this case. But if the present value of the obligation is higher than what we have planned, then we'll have actuarial loss. So that's just for that. So another thing to note is the recognition of the net benefit asset or liability. This is to be recognized in the statement of financial position, either an asset or a liability. So we'll have a net benefit asset if the fair value of the planned asset is greater than the present value of the obligation, which is the liability. So if the fair value of the planned asset is greater than the present value, if the fair value of the planned asset is greater than the present value of the obligation, so if this exceeds this, they will have a net benefit asset. So this will be our net benefit asset, which should be recognized under the non-current asset in the statement of financial position. While the other one, which is the net benefit liability or net benefit obligation, anyone, It's just the other way around. If the present value of the obligation if it exceeds the fair value of the planned asset, then we'll have the net benefit liability. This also should be recognized under the non-current liability, although there's an exception to this. If the maturity is just within 12 months, remember, anything that does not exceed an accounting period should not be classified under the non-current asset or liabilities. So if the maturity is within an accounting period, then it should be classified under the current liability. Likewise this, if it can only generate economic benefit within an accounting period, that's just within the scope of 12 months, then it should be recognized as a current asset. But ordinarily, the net benefit asset and net benefit liability are regarded as long term. So it should be recorded under the non-current assets and non-current liabilities, except for those separate conditions. So another thing to note is for the statement of profit or loss, like we said, that these are for statement of financial position. Recognize these financial position, assets or liabilities. So for statement of profit or loss, so recognize the expenses. This is just an extract. So we have the service cost, then we have the net interest, we have the interest paid, we have the interest earned, the net of the two is what we're transferring to either expense or income. But here we're taking them all as an expense. So note that if this interest earned is higher than the interest paid, then we'll have a net amount here. It will not be added to it. Again, I take it again. If this interest earned, the value we have here is higher than the interest paid, it means we'll have a remainder which will belong to the interest earned. We've deducted the whole interest paid from the interest earned and having a remainder. Interest earned is not an expense, it is an income. It's an income. So we'll deduct the service, we'll deduct it from the expenses, which is the service cost, or we'll deduct it from the total expense. But on the other way around, if the interest paid exceeds the interest earned, then we'll have net interest, which is still an expense. So on the other way around, if the interest paid exceeds the interest earned, then we'll have the net interest expense, which is the interest expense, which should be added as part of an expense, added to the service cost, to the expense. Again, I take that again, that if the interest paid is higher than the interest earned, this earning is an expense. So if the interest paid is higher than the interest earned, then we'll have an interest expense left, which should be added as part of the expenses. But if the interest paid is lower than the interest earned, it means what we will have as a remainder is an income, and it should be deducted from this service cost, or should be deducted from the expenses generally. So that's that. So I'm taking this as an assumption that the interest paid is higher than the interest earned. So So that's just an extract. We'll have this under the statement of profit or loss element. And lastly, we'll have under other comprehensive income. We'll have actuarial gains or loss. So that's other comprehensive income. So under our other comprehensive income, we'll have the actuarial gains or loss there. Just like we said, the actuarial gains are gains derived based on assumption. We have assumed that we'll make this certain amount, and then afterwards we made more than that, we'll have actuarial gain. Then we budgeted that we'll make this certain amount, but we made less than that amount, then we have actuarial loss. So that's just that. Or for the liability, we budgeted that we will pay certain amounts, but eventually we paid more than that. That's actuarial loss. But we budgeted that we'll pay an amount, but we paid lesser than that. The differences become the actuarial gain. So it's just very simple, just like we've illustrated before. So we'll take an example now to illustrate. So we'll take an example to illustrate what we've been talking about. All right, so the example now. XYZ Limited is a company that operates a defined contribution plan into which it makes an annual contribution of $15,000 per employee. The company employed a total 30,000 staffs for the year ended 30th June 2024. Now required, prepare the financial statement extracted for the year or for the period ended 30th June 2024 under the following independent assumptions. Just like we talked about that. The defined contribution plan has no big deal. The company makes a particular fund to a separate entity to service the post-employment benefits on their behalf. So they are just paying the separate entity, which is like a fund account, to service this post-employment benefit for them. So according to this question, we have XYZ Limited. So the number of staffs, according to the question, is 30,000. And contribution per employee is $15,000. So total contribution will be 30,000 multiplied by 15,000, which is 30,000 times 15,000. So we have 450 million. So that's the number of staffs multiplied by contribution per employee will give us the total contribution. So $450 million is the amount they will be paying, which is a fixed amount like we talked about, to the separate fund, just like the pension fund administrators. So required now, prepare the financial statement extract for the year or for the period ended 30th June 2024 under the following independent. We've talked about components of financial statement in the first class. XYZ Limited. We have the extract of the statement of profit or loss and other comprehensive income for the year ended 30th June 20x4. So for statement of profit or loss, is either we have the revenue, cost of sales, income, expenses, then other comprehensive income. So the contribution to be paid is an expense. So it says under the following assumption, if XYZ Limited paid a contribution of 420 million, so the expenses, so if a contribution of 420 million, 450 million is paid, so in all cases, it will be recognized, the amount paid will be recognized as the total expenses. So in this case, we'll have 450 million as the expense. That's one. So since the total amount required to be paid is actually the amount paid, this is contribution paid, then it means we don't have an asset or a liability. Since what we are supposed to pay is 450 million and what we eventually pay is 450 million, then there will be no assets, no liability. The second part says XYZ Limited paid a total contribution of 520 million. What is required of them to be paid is 450 million. What to be recognized as an expense is the actual amount required to be paid, which is contribution, to still be 450 million. Since 450 million is what is expected of them to be paid, it is still what will be recorded as an expense every year. Like we talked about that under defined contribution, we have a fixed amount that will be paid by the entity to service this post-employment benefit. So 450 million is still what will be recognized as an expense. But since what was paid, since they paid XYZ Limited paid 520 million, automatically they have paid more than what is expected of them to be paid. So they will have an asset, which is a prepaid expense. So they will have prepayment. You paid more than what you are expected to pay. So you will enjoy future benefits from what you have paid. So prepayment, which will be 520 minus what is expected of you to be paid, which is 450. So 520 minus 450 now, to give us 70 million. So we have a prepaid expense of 70 million in the first year or in the second scenario. So we have a prepayment of 70 million. Prepayment is an asset, a current asset. Current asset. Then lastly, they said if XYZ Limited paid a total contribution of 300 million subsequently, what is expected of them to be paid is still 450 million. Expenses will still be recognized even if they have not fully paid the amount according to the accrual basis, which we talked about. The expenses are recognized when incurred and when not actually paid for. So contribution will still be 450 million. What is expected of them to be paid is 450 million, which should be recognized as the expense. But what they paid, so XYZ Limited now, they paid 300 million. So they have an obligation to pay 450 million. They paid below 450 million. They paid 300 million. So automatically they will have a liability, meaning that they will settle the remainder subsequently. So they will have a liability, which is prepayment and payables. So this is payables. Um, So we'll have payables, employees benefit, or pension, or anyone, according to the question. So payables of what they are expected to be paid, what is expected of them to be paid is 450 million, but what they paid is 300 million. So they will still be owing an amount which is 150 million. So here they will be owing 150 million. So these are the three instances. We've recognized expenses, which is 450 million in each cases. What is expected of them to be paid is 450 million. But for the statement of financial position now, XYZ Limited. So we have the extract of the statement of financial position. As at 31st, sorry, 30th June 20x4. So we have assets, which is non-current assets, or let's say current assets. So we have current assets. So in the first instance, they paid 450 million, and what is expected of them to be paid, what they are expected to pay is 450 million. Then it means there's no prepayment and no accruals. So what they are expected to pay is what they eventually pay. So there will be no asset, which is prepayment, or accruals, which is a liability in that case. But subsequently, they paid 520 million, and they are expected to pay 450 million. So there will be a prepayment, which is prepaid expenses. They are paid in advance of 70 million. So here we have prepayment, 70 million. Then lastly, they paid 300 million, whereas they are supposed to pay 450 million. So there will be a liability, which we've done here, payables, that's employees benefits, that's OAs, 150 million. So 150 million should be recognized ordinarily as the liability, which is the payable. But since we have previous prepaid expenses on the same condition, then we can net them off. So they have a liability of 150 million. They have previous prepaid expenses of 70 million. So we can net off the previous prepayment against the current liability. So in the subsequent year now, we will no longer have prepaid expenses, because we will take out 70 million out of these 150 million that they are owing. They have 70 million advancement previously in their books. So now they are owing 150 million. We can reduce the 150 million by the previous advancement, which is the prepayments that they have. So currently now, what they will be owing will no longer be 150 million. It will now be 150 million minus what they have settled before. That's the advancement, that's prepayment, minus 70 million. So currently, what they will recognize as their liability as at the last period will just be 80 million. And this would have been removed. So the prepayment as at that period would have been removed. So there will be no prepayment as at the year end. There will be no prepayment. So that's for that. So since they have a prepayment or a payable of 150 million in the current year and they have a previous prepayment of 70 million, the current payables can be net off with the previous prepayment of 70 million. So currently the liability that will be recognized will no longer be 150 million. It will be the net amount of the two. So the payables, which is the contribution fund, employment benefit. So instead of recognizing 150 million now, what we'll recognize will be 80 million. So that's for the question. And that is how it will be to be shown on the face of the account. But for the expenses, 450 million will still be shown every year because it's a fixed amount which is to be remitted at every period, every interval. So, but for the statement of financial position, they can net off the prepaid expenses with the arrears of the same information. So, which has been done now. So, instead of recognizing 150 million in this period, because we have previous 70 million prepayment on this same employee benefit, we can reduce our current liability with the previous asset on the same employees benefit, which is why we have 150 million minus 70 million, giving us 80 million in this current period. So that's for that. Then the second question, which is on defined benefit plan. So here it says Prince PLC provides post-employment benefits to its employees through a defined benefit plan. The following data relates to the plan of for the year ended 30th September 20x6. Present value of the obligation as at 30th September 20x5. The present value of the plan asset as at 30th September 20x5. The benefit paid, contribution paid, current service cost, past service cost, the present value of obligation as at 30th September 20x6, and the market value of plan asset as at 30th September 20x6. Now, the discounting rate at the start of the year is 10%. Now, required, calculate gains or loss on remeasurement of planned assets and pension fund obligation. Show the financial statement extract for the period ended 30th September 20x6 and explain the reasons for the new balance of net assets, of net interest and net pension assets or liability. So the first information which says we should calculate the gains or loss on the planned assets and the obligation. Well, so let's start with the planned assets, which we've talked about the format before. Planned assets. They said the fair value of the planned asset as at the beginning of the period. If for this period is ending 30th September 20x6, the year end of the previous accounting period becomes the opening balance for this year. So 30th September 20x5 becomes the balance at the beginning for 30th September 20x6. 30th September 20x6 will be the end of the accounting period. So the start of the accounting period will be 30th September 20x5. So which is the closing balance for the previous accounting transaction. So at the beginning, we have 16,000, which is 16 million, but it has been suspended to that. So 16 million. We said we'll deduct the benefit paid according to our format. Benefit paid of 2,500, which is 2,500,000, We'll add contribution paid, which is 1,800. The current service cost is for the obligation, which is the liability. The same thing for past service cost is for the liability. Then that's for that. So we have interest. Since this is an asset, we'll have interest earned. They said the discount rate at the start of the year is 10%. So we have 10% of the value at the beginning of the year, which is 10% of 16,000, which will give us 1,600. So this gives us the estimated value, just like we've talked about. So the estimated value now is 16,000 minus 25 plus 18 plus 16. So we have 16,900. So the fair value of the plant asset at the end now, which is 30th September 20x6. This is 30th September 20x5. That's the opening balance. This is the closing balance. So the closing balance, they said, is market value of the plant asset as at 30th September 20x6 is 17,500. So, like we said, that if the estimated value of an asset is higher than the fair value, then we'll have actuarial loss. But if the estimated value is lower than the fair value, then we'll have actuarial gain. So here, we have estimated that we'll make 16,900 as an asset, but eventually we have 17,500, which is an actuarial gain to us, based on assumption, since this is an asset. So this is actuarial gain, which is the difference between the two. So there's an actuarial gain of 600. Then the second one, for the obligation, which is obligation, liability. We have the present value. Let me just shorten it. The present value of the obligation as at 30th June 20x5. That's as at the beginning. So the obligation's value at the beginning is also 16,000 according to the question. Then benefit paid. It said benefit paid will be deducted in both cases. Benefit paid. Benefit paid of 2,500. Then we will have the current service cost. So the current service cost, according to the question, is 3,000, which will be added since it's a liability and expense, they are together. Then the past service cost, the treatment is the same. Past service cost which is 500. So lastly, we have the interest paid, which they said it is discount rate at the start of the year. So that's 10% of the value at the beginning of the year. So this is the value at the beginning of the year, which is 16,000. 10% of 16,000 also, which is still 1,600. So this is interest paid. It will still be added as a liability. So this will give us the estimated value. So estimated value, we have 16,000 minus 25 plus 3,000 plus 500 plus 1,600. So we have an estimated value of 18,600. So the present value of the obligation as at the end, which is 30th June 20x6 now. So according to the question, the present value of the liability at the end of the period is also 17,500. So we have budgeted that we will be spending this as a liability. 18,600 will be our liability. But eventually our liability is 17,500. So we'll still have an actuarial gain, which will be the difference between the two, which is 1,100. So since we have actuarial gain on plan assets, we also have actuarial gain on the obligation, which is liability. So automatically, what will be going to our other comprehensive income will be 600 plus 1,100, which is 1,700. Then that's for that. So they said we should show the extract of the statement of the financial statement. Let's start with statement of profit or loss. So extract of statement of profit or loss and other comprehensive income for the year 30th June 20x6. So what we are going to have here, said we have expenses. Don't forget expenses. So here we have one of the expense to be contribution paid. We have one of the expense to be current service paid. Current service paid or current service cost, which is the current service cost is 3,000. We have the past service cost, which is 500. We have the net interest, like we've talked about now, the net interest. We have interest expense, which is interest paid. So let me just make it interest paid. So interest paid is 1,006. Interest earned also. Interest earned. Interest earned is also 1,006. So automatically will not have any net interest because the two will cancel each other. This is an income, this is an expense. So we have a net interest balance. So what will be taken as an expense to our statement of profit or loss will be 3,500. And now to other comprehensive income. We'll have the actuarial gain for the assets. We also have actuarial gain for the liability. So we have actuarial gain. Like we said, the actuarial gain or loss, they are just gains or loss on assumption. So you cannot take them to profit or loss because they can still change in the future until they are realized they are part of that comprehensive income item. So actuarial gains or loss, which is 600 plus 1,100 plus 1,100, which will give us 1,700. So that's that. Then extracts for the statement of financial position. This is Prince PLC, don't forget. So extract of statement of financial position. As at 30th June 2026. So we have the net benefit assets and net benefit liability. Which is net benefit assets. We don't have anything. Then for the liability, non-current liabilities, net benefits obligation. We also not have anything. So that's on the question, and that explains the calculation of the defined benefit plan and also the defined contribution plan. So I believe we understand better the concept of IAS 19 employees benefits. We've talked about the definition, the types, the examples, the defined contribution, and also the defined benefit plan under the post-employment benefit. So I believe you understand all about IAS 19 employees benefits. But in case there's any other question, is you can use the comment section and we'll get back to you. So thank you very much for staying by with us. This is Study with Greg, and my name still remains Gillian. Please like, share, and subscribe. Share to as many as possible people. Thank you very much.